If you've ever sat across from an accountant or tried to read your own financial reports and felt like they were speaking a completely different language, you're not alone. Words like gross margin, liabilities, direct costs, they sound complicated, but they really aren't once somebody explains them to you. Hi, I'm Carmel, owner of Profit Flow, your cash flow strategic partner, the missing piece between revenue and real profit, and host of Profit Over Turnover. This is why I set up the channel. I want to empower you as business owners so that you understand your numbers and make better business decisions. Ultimately, I want you to make more money. So today we're going to start at the beginning, and I want to break down some of the jargon that accountants use. We don't make it easy for people because we have different words for the same thing, which drive people crazy. So sales, turnover, revenue, all the same thing. So if I sometimes use them changeably because I don't like using the same word all the time and think it might sound better. They're just the same thing. So we'll go through some of the more common phrases that you will have heard. And don't worry that if you're just starting out in business or you've been running them for years, understanding these numbers isn't just for accountants, it's for you. That is one of the things, so you can understand what they mean and how to and what they mean to you in your business. So let's get into it. So first of all, we have assets and liabilities. So assets are anything kind of good in the business, but if the business owes or is owned, that has value. So it's going to be your cash at bank, it's going to be your equipment, it's going to be stock, and any money that customers owe you. So a liability is the opposite. So it's going to be anything that the business owes to someone else. So it could be a bank loan, it could be a credit card balance, or it could be supplier invoices. So a simple way to look at this is that assets put money into your business while liabilities take money out. And so the difference between the two is the net worth of the business, or it can be a way of working out the value your business is. So it's assets minus liabilities. And we always want that to be positive, and we always want you to have more assets than liabilities. So direct costs and indirect costs. So we're going to look at these costs in your business and how they're categorized. And this is a typical example of accountants using the same words to mean the same things. So if we look firstly at direct costs, so they can be called variable costs, they can be called cost of goods sold, they can be called cost of sale. So it really is a cost that is directly linked to a sale. So, for example, if you were a builder, so the bricks that you would use or the labor that you would use to do a job are direct costs. So the idea is that if you didn't do that job, you wouldn't have used those bricks, you wouldn't have used that labor, and therefore you wouldn't have incurred any costs. So therefore, no job, no costs. So direct costs then tend to go up and down with your sales volume. Indirect costs then or fixed costs, or they're sometimes called overheads or expenses. They keep the business running regardless of how much sales you do. So they're the rent, the insurance, the owner's salary, say, are classic examples, or you might have subscriptions. So these are costs that while you're sitting in your office twiddling your thumbs, and you would still have to pay. If most of your costs are indirect or kind of fixed costs, so if you had a big sale come in, then that would be very profitable for you. So that most of that would hit your bottom line, because there's no costs incurred in that sale. So understanding this split is really important because this is how you're going to manage where your spending is, whether or not it's directly linked to the sale or whether or not it's an overhead. And that tells you then which you have to try and fix. And it shows you where your attention needs to go. And that leads directly into your gross and your net margin. So this is really, really important for businesses. And it's the one metrics that every business should be looking at is the margins. So your gross margin is what's left after your revenue, after you subtract your direct costs. It tells you how efficiently you're delivering your product or your service. Now, net margin is what's left after all costs, so including all of your overheads have been deducted. So gross margin is telling you the health of your core offering, while net margin shows the health of your whole business. You, as a service business, you may not have a gross margin. It depends how your business is set up and how you deliver your business. However, everybody has a net margin. So, um, and typically they work in tandem. So a business can have a great gross margin, but then still be losing money when their overheads are out of control. And this is why it's so important as they work out what percentage it is to understand that you're in the right, that you put the right cost in the right competitors. However, this is something that is so important. I am dedicating a whole episode to this in another session. So do check that out. So the next I want to talk to you about cash and profit. So sometimes cash is gets mixed up with profit, and they are two different things. And for want of a better word, profit is an accounting number. So it's your revenue minus your costs. Now, each product that you deliver and each sale that you make for service needs to be profitable. However, that tends to be on paper, and it doesn't take any um, value on in time. It doesn't take that if you're giving your customers credit or your suppliers are giving you credit or you have to pay your suppliers before you receive the goods. It's not taking those things into consideration. So cash flow is actually looking what's moving through your business. So you can be profitable on paper and still run out of cash. For example, if customers are slow to pay or you have to pay your suppliers upfront. So many businesses that fail are not unprofitable. They simply ran out of cash. And this is why watching both numbers, not just profit, is so important. Now, I want to introduce break-even point. So, break-even point is simply the level of sales at which your business covers all its costs and makes neither a profit or a loss. So, this number is very important because you need to have this, maybe it's 5 hours of services a week, or maybe it's 100 units sold. You need to know what that number is in your business so that you know that you're always going to reach this, because at that point, you're not taking a profit, you're not making a loss, but all of your expenses are covered. Um, so that is, so I'm also doing a full session on that later on. So that is coming, but it's just to give you an idea of some of these terms that you're hearing at meetings and at networking events, what they mean and how you can bring them into your own business. So if any of these hit home for you, I'd love to hear which one in the comments. And if you want to actually start using these numbers in your own business, I would encourage you to check out Profit Flow. It is built specifically to help owner-led businesses make sense of their finances without needing an accountant to row in the room. So organize a demo today. And if you haven't already, please subscribe and I will see you at our next session. Thank you for listening to Profit Over Turnover.